a very warm welcome. Mr. Taylor is sitting in the UK joining us from there, and we thank you again for your time and all the work that you do for our FIA members. Thank you, Barry.
Thank you, Sandra, and a very warm welcome to the panel and to all those attending this morning. So just by way of some background, we're all aware as to the effects of the hard market cycle, which seems to have been more severe than past hard cycles. Or maybe it is the markets that have become too easy over the years. Whilst the global markets appear to be easing, it is not at the expense of sound housekeeping and attention to the managing and mitigation of risk exposures. A risk plan is essential with a proportionate approach to the size and complexity of risks. Insurance cover is no longer seen as the only solution. It takes its place as one of the pillars of risk mitigation. We continuously hear it is the reinsurers, it's the protection gap, systemic and uninsurable risks, natural catastrophes, climate change, and so on. So today we have the pleasure of listening to the wise words and the experience from James Eisen, who's the head of property and speciality, and Norman Sharby, head of property and speciality, representing the Swiss Re Corporate Solutions Company, the team who are part of the large and greater Swiss Re robust global network. So thank you to James and Norman, and not to forget Corinne, who's sitting in the background, for the many hours. I can tell you we've had numerous meetings and many hours spent in putting this presentation together. And then, just as a bit of an advert for the Swiss, thank you for the coffee and the chocolates when visiting your Sandton office. So it gives me pleasure now to hand over to James and Norman. We look with great interest in hearing your presentation this morning. Thanks very much.
Thanks a lot, Barry. And good morning to everybody. A very warm welcome to this FIA webinar on emerging risks. My name is James Eisen, as Barry said. I'm the head of property and specialty at Swiss Re Corporate Solutions, and alongside me this morning is senior property underwriter Norman Sharby. So really the purpose of this webinar today is to highlight the evolving nature of risk and the critical role the insurance industry plays in risk mitigation. We will demonstrate how insurance is an important facet of a comprehensive risk management strategy, and demonstrate how the insurance fraternity should broaden their perspective to remain effective. The message we want to leave you with today is that the insurance landscape is shifting due to emerging risks like climate change, cyber threats, economic uncertainties, geopolitical events, and must therefore transition from traditional roles to become a more proactive participant. And without further ado, I would like to introduce Norman Sharby, who will kick off this event for us. Norman, thank you.
Thank you, James. Good morning, everyone. It is a great privilege to have this time this morning to chat to you about emerging risks. This is a very topical subject, as we all know, and we've heard from news clippings here and there about emerging risks. But today we just want to focus on what they are and why we should care. Let's start right at the beginning. Risk is part of everyday life. The chance that something unexpected might happen, good or bad, is part of everyday decisions. You woke up this morning, some going into your cars to come to the office. If you really think about it, those are calculated risks that we have taken. But what are emerging risks? We know that emerging risks are not new at all. If you think back to the Industrial Revolution, the first Industrial Revolution, the development of steam engines brought about emerging risks that the society then had to deal with. If you think of mechanized textile production and ironworks, all of this, they brought their kind of emerging risks that the society then, and indeed the insurance industry, has had to deal with. So we can see that the insurance industry has had a long history of identifying, adapting to, and even mitigating emerging risks. I mean, if we come back to the current environment, we've had a few notable instances or examples where the insurance industry has had to deal with emerging risks. If you take, for example, asbestos liability. Before we knew the dangers, asbestos was used widely. roofings, protective clothing, and so forth, until we realized that it could cause serious health challenges. What did the insurance industry do? They adapted. I mean, initially it was general liability. All those claims were put under general liability, but we have now realized that there are better ways of dealing with this. The just recent pandemic was also another systematic risk, an emerging risk that the world had to deal with. So terrorism risk, I mean, post 9/11, terrorism became a major insurable risk. And you'd see how the insurance industry adapted. They set up pools, models to assess terrorism risks. So we have dealt with emerging risks up to so far. But what did we learn? What did we learn from all of these emerging risks? We learned that, and this is the message that we want to leave you with as we go through the presentation. Please remember these points, that preparedness is key. It's key to building resilience, because it is important for businesses, governments to build resilience against emerging risks and crises that may occur. So what does that mean? That means early identification allows for the development of these strategies that we're talking about. There are financial reasons also to understand and be prepared for emerging risks, because underestimating some of these emerging risks may have massive challenges and massive claims that insurers and the insurance industry has to deal with. If you think of cyber, underestimating cyber could result in massive claims that we have seen. There's also an innovation and opportunity, and we want to highlight this in later slides, what opportunities are available from emerging risks, because we know that understanding the risks can lead to innovative solutions, innovative insurance products. I mean, cyber insurance itself, cyber liability insurance itself is a response to all of these things. Parametric insurance, which of course is not yet readily available in South Africa, was also a way of dealing with some of these emerging risks, which the traditional insurance market could not do. It is also important to be prepared. Why? Because there could be significant regulatory implications for not dealing with emerging risks adequately. You could face penalties. You could face loss of trust. For example, in the 1980s, if you think about it, insurers were overwhelmed with the asbestos-related claims that I spoke about earlier, which were inadequately priced and reserved for. But the insurance market had to reposition itself. And now we feel that we are able to deal with this. And also, there are also systematic issues that we need to think about. For example, some emerging risks, for example, COVID-19, for example, that I mentioned, and climate change are systematic. They affect entire economies, and insurance plays a key role in spreading and managing these risks, reducing the burden on society in general. So these are the reasons why we should care about emerging risks. And as we go through this presentation, we'll try and extract each and every one of these points so that we can see where we stand. So let's then look at what emerging risks are. Emerging risks could be termed threats or risks that are either new or evolving and could cause harm to people. And I think the key to this is that we have not yet fully understood what an emerging risk is, and therefore have not come up with effective management strategies. These risks could arise from many sources. New technologies, we can see how AI, quantum computing, and biotechnology bring in new risks that society may not have prepared for. Social and geopolitical shifts also may lead to emerging risks. For example, I mean, if you think of demographics, where people choose to settle, how we go about our business, these could also lead to emerging risks. But very importantly, and I think this will be the focus of our presentation today, environmental changes, including climate volatility and biodiversity loss, they also lead to emerging risks that we, as the insurance industry, have to grapple with, come up with solutions on how we can deal with them. So what sets a risk from an emerging risk and standard risk from an emerging risk would be things like they're difficult to model. In many instances, because they're emerging, they will lack historical data, and the impacts would be difficult and hard to predict. Some of the impacts may not have yet manifested themselves. So what we're saying is they require new approaches to assess and insure against. So the challenge is not about definition, not at all. Because risks, we know, we can define risks, but the real challenge in how we anticipate, adapt, and respond to them. And this is what we are going to try. This is a nugget we're going to try and leave you with today. How can we respond, anticipate, and adapt to emerging risks? Be that as it may, there is consensus. There is consensus on emerging risks. And what is the consensus? The World Economic Forum did a study. They do a study every other year where they asked risk managers, over 900 experts across the world, ranging from academia, government stakeholders, civil society, and indeed the insurance industry, on what they thought the emerging risks are. And they did this in 3 tranches. They looked at the short term, which is current, 2025. They looked at the medium term, which is 2 years, and the long term, which is about 10 years. And what did the survey reveal? It revealed that state-based armed conflict was key, top of mind for many people. If you look around the world today, America has just bombed Iran bases. Iran has just bombed back America. Israel is bombing everyone else. Everyone else is bombing. So these are issues that were top of mind. But the second one is very interesting because you'll see on the next slide why. Extreme weather events were highlighted as the second most top of mind emerging risk in the minds of people. How about a long-termish view? So 2 years' time, people thought misinformation and disinformation will present one of the biggest challenges to society. This risk, as we said earlier, is magnified by the adoption of generative AI. You could, if you wanted, put a picture of myself with my voice saying things that I never said, and we see how these things are. Deepfakes are all over the place, and we have seen voices, videos, cloning, and all sorts of things happening at the same time. So AI is rapidly emerging as one of the most powerful technologies in human development. And indeed, I employed it in preparation of this presentation as well. It helped. So it's useful. But again, we see that it also comes up with emerging risks. And if you look now at the 10-year long-term horizon, extreme weather events by far are anticipated to become even more concerning than they already are. And with this ranked as #1 in the 10-year horizon. So environmental risks will continue to dominate the risk landscape, as we shall see in the next slide. There are other notable emerging risks, which I shall not spend time on, but I'm sure you've heard about them. I mean, if you think of supply chain disruptions, pandemics, geopolitical instability that we're facing now, labor shortages, they will continue to impact the global supply chain. We all know what happened a couple of years ago with the Japan earthquake, with the disruption in the semiconductor industry. The world still remains vulnerable. So, but why is all of this important? Why indeed? Because thinking about all of these emerging risks, spending time on them, thinking of ways of adapting will bring preparedness. Let me spend a few seconds on this slide. What we are advocating for is not prediction. We don't want to predict what emerging risks are, how they will come, but we are proposing that preparedness is more important. Let me give you an analogy. If I say it will rain at 3 p.m. today, that's a prediction. But if I say there's a chance that I should take an umbrella because it might rain, that's foresight. I'm looking at the clouds and I have foresight in what may happen later on. So prediction says this will happen, but foresight explores the possible futures, the possibilities that will happen so that we can be ready for change. So this is what we're saying. foresight that we need to have as an insurance industry is not about preparedness per se. I apologize. It's about preparedness, but not about prediction. So, because we know the future is uncertain, especially with the fast changing technology that we're seeing. So predictions will fail because things are constantly changing on the side. On the other hand, foresight helps us to anticipate a range of possibilities when it comes to emerging risks so that we can build resilience, we can spot the weaknesses in our systems before they become big problems and start to make flexible, adaptable adaptations. So again, to just summarize that, foresight is important because it helps us understand the risk landscape, the current risk landscape, understand what the triggers are, understand what the emerging trends are. Then this helps us to mitigate and avoid that risk. But we also put it forward to you to say, this may bring about new business opportunities for the insurance industry, as we shall see later. I turn over to James to chat about this. The next slide. Yeah.
Thanks. A growing threat to insurability in South Africa. South African local news and industry sources are increasingly highlighting the growing threat to insurability due to climate changes, with several key developments this year alone. If we look at the screen, climate change poses a significant and quantifiable risk for the insurance industry. Norm, if you could just flick across there, please. If we look at some of the research and some of the numbers, why climate risk resilience matters. More than 50% of retail customers are concerned about the future insurability of natural disasters. This was a study undertaken in 2020. NatCat losses hit $108 billion in 2023. 50% of global GDP is dependent on nature. And this, of course, is extremely exposed to extreme weather conditions. And in 2023, only 40% of the economic losses were covered by insurance. So we can see a number of issues that are relevant at this point in time. So if you can flick over. If we look at the advanced versus emerging economies, this slide shows that there is evidence that the protection gap is larger in emerging economies, where an average of 94% of economic losses are uninsured. It further depicts that the three major perils, storm, flood, and earthquake, have been relatively stable over the period, both in emerging and advanced economies. If we look at the columns, the green and the black representing emerging and the green representing the advanced or mature economies. And that the protection gap for earthquake and flood is relatively higher than for storm, even in advanced economies. I will hand back to Norman.
Thank you, James. I mentioned earlier that we will focus on climate risks and why they are important. And James just alluded to the gap, the insurance gap that's created due to climate risks. But why is it a growing threat? Why are climate risks a growing threat? So as we deepen our understanding of climate change, it is important to recognize that the risks it brings are not the same. But we can broadly classify them into three categories based on the cause, impacts, and implications. So the first one would be physical risks, which are most visible. We all see this. These are things like floods, droughts, wildfires, and extreme storms. They directly impact property, disrupt supply chains, and threaten lives. The second category would be the transition risks. Transition, as we shift to a low carbon economy, there are costs associated with that and risks that are associated with that. Think of new regulations. I mean, if carbon taxes are applied or changes in the market preferences. So for example, Eskom, a company that we all know, it's heavily invested in coal. They may face financial losses as the world transitions towards renewable energies. And there are risks that are associated with that. And of course, there are legal risks that arise out of emerging risks, climate risks. For example, legal and reputational risks. As awareness grows and companies and governments may be held accountable for the climate change that we are already seeing. So understanding these types of risks will help us build more resilient strategies, and not just for insurance, but for business continuity and the society at large. But there is consensus that there is one thing that is causing climate change and will continue to increase climate risks. These are greenhouse effects. Now that we've seen how climate risks can be categorized, let's take a step back and look at one of the main drivers, which I just mentioned, which is greenhouse gases. Greenhouse gases like carbon monoxide, methane, nitrous oxide, and so forth, they trap heat in the Earth's atmosphere. This is a natural process. But because of human activity and human behavior and this industrialization that we have become accustomed to, they have intensified in their effect dramatically. We burn fossil fuels, we deforest our huge forests, and the various industrial processes, they all lead to an increased concentration of these gases that we're talking about, and which will then lead to global warming and a long-term rise in the average temperature. This warming of the world, of the atmosphere, is what fuels many of the physical risks that we see. Intense storms, rising sea levels, very importantly, and prolonged droughts. So understanding how greenhouses become key in climate change will also help understand the mitigation solutions that we have to come up with and how we adapt to this ever-changing world. The effects are well spread. I mean, let's explore why rising temperatures are such a big deal or a big concern for us. I mean, if you look at the first thing is excessive ice melting, especially in the Arctic and Antarctic. This directly then leads to rising sea levels. But this not only threatens polar and Antarctic ecosystems, but contributes to rising sea levels across the whole world. As the seas rise, we're also seeing increased coastal flooding, which puts millions of people, homes, and businesses at risk, especially in low-lying areas. Warmer temperatures will then also disrupt biodiversity. Many species can't adapt quickly enough to changing climates, and therefore we're going to see an increased extinction of some of these endangered species. Mangroves, you know, that you find on the coastal areas, coral reefs are very particularly vulnerable. These ecosystems protect shorelines and support fisheries, but because of our increased human activity, rising temperatures, it's had a disruption on their ecosystems and the protection that they give to coastal areas. Finally, rising temperatures, as we all can imagine, will affect agriculture. In many regions, it's becoming harder and harder to grow crops due to the heat stress. Because the average temperatures are ever increasing, there are water shortages and shifting weather patterns all over the place. This threatens food security and rural economies. For now, I'm going to give the mic to James to speak a little bit about extreme heat waves.
Thanks, Norm. And to further aggravate the situation, extreme heat becomes more deadly than floods, earthquakes, and hurricanes combined. This is a report that was conducted by Swiss Re Sona. Human lives lost to extreme heat exceed the total from earthquakes, floods, and hurricanes at around 480,000 fatalities a year. That's extreme. Heat-related risks extend to wildfires, healthcare systems, infrastructure, and agriculture. This is clear evidence that extreme heat events are happening with greater severity, frequency, and duration. July 2024, last year, saw the hottest 3 days ever recorded on Earth, with the daily global average temperature reaching a new high at 17.16 degrees Celsius. Heat waves coinciding with strong winds can also increase the likelihood of wildfires. This we have seen in NISLA, in LA. According to the Swiss Re Institute, global insured losses due to wildfires reached $78.5 billion during the 10 years from 2015 to 2024. Liability risks have already started to emerge, with corporates and institutions facing legal action, as Norman has mentioned, for failing to mitigate heat-related harms. In 2021, a lawsuit saw a US plaintiff seeking 52 million rand from fossil fuel companies for losses caused by climate change, extreme weather events. Extreme heat is therefore set to intensify litigation, which in turn drives up liability claims for insurers. And recently, and back at home, we see that Tokyo Marine, the in-house insurer for Toyota, has levied a claim against KwaZulu-Natal for storm-related losses experienced in 2022 KZN floods at 6.5 billion. Why is this significant? Norman will take us through this part of it.
Thank you, James. Thank you very much. So now that we've seen how climate change leads to physical transitional, if you wish, and liability risks, and how rising temperatures amplify those risks, let's step back a little bit and let's look at what actually drives the losses that we're seeing on the ground. If you look at the picture on the left, that was Shanghai in 1990, and this is Shanghai now in 2010. The one at the bottom, look at Ocean Drive, Florida. That was 1926, but look at it now in 2000. So we see that as economies grow, we build more infrastructure, we build more homes, businesses expand, which simply means that there is more at stake than there was in the past. So economic development increases the value of assets that are exposed to climate hazards. The other thing as well is we all like to be close to economic zones, very convenient economic zones, but unfortunately, these areas may be high risk in some areas. For example, coastal zones, floodplains, and wildfire-prone areas. Urbanization and tourism often drive this trend, but we can't stop it. This is what we are. So how do we prepare? The other important thing is that insurance penetration is very key, especially in developing regions, which is very low. The penetration is, and the gap that James showed you there between developing countries and developed countries is very important, because this means that when disasters happen, few people are often insured against these natural or climate risks. And they have to bear the risks, the full cost of these risks themselves, slowing recovery and, of course, increasing vulnerability. So vulnerability isn't static, it changes with building standards, land use, and social conditions. So poorly built infrastructure, for example, informal settlements like we have replete in our country, and lack of early warning systems may all increase impact of climate. In terms of early warning systems, if you remember the floods that we just had in the Eastern Cape, one of the issues that has been highlighted there is people did not take heed of the warnings, or the warnings were not given enough. And therefore that led to all sorts of losses, loss of lives and loss of property. Finally, hazards of change. We have seen how the effects of man or our actions on this planet, in fact, have an effect on the climate risks. They're changing. Climate change is making extreme weather events more frequent, more intense, and less predictable. Therefore, fitting perfectly in the definition of what we call an emerging risk. So, taken in whole, these 5 points on the right, they explain why climate-related losses are rising and why managing those risks today requires more than just looking at the weather. It's about understanding how society functions, our infrastructure, where we build, and the systems that interact directly with the climate. I'll just leave this here for you if you can see to read. And we'll move to the next slide. So, understanding the drivers, like we say, it is very important. It really is important, and here's why. If you look at the frequency there, that top little thing, the frequency of climate-related risks is changing, and it's ever increasing. We are seeing more frequent floods. We are seeing more frequent heat waves and storms, of course, that accompany those. But the patterns are irregular and evolving. This makes it hard to rely on historical data to predict how often these events will occur, because they are overchanging by all our actions. When extreme events happen, they are often more intense than before. So we see that severity is also on the increase. A single event can cause billions in damages, but predicting how severe the next one will be is very, very difficult. Then there's a time horizon. Some risks like sea level rise, they unfold over a long period of time. Others like flash floods, they happen in an instant, or wildfires that can strike suddenly. Insurers must balance short-term pricing with long-term exposures, and that's often a very difficult equation to solve. Finally, the level of confidence is also important. So the level of confidence in climate models and risk projections varies. With ever increasing and changing climate risks, and it becomes very difficult to have a high level of confidence. But while science is improving, there's still uncertainty. So especially on the local and regional level. So this makes it hard to set premiums. This makes it hard to design products or even make investment decisions with full confidence. So while we know that climate risks are growing, the challenge lies in quantifying them accurately and doing so in a way that supports both financial stability of the insurance industry and, of course, customer protection. So we spoke about climate risks, but there's also mention of secondary catastrophe perils. What are these? Now that we've developed and explored the complexity of understanding climate risks and the loss drivers, it is important that we look at the type of natural catastrophes that drive these losses and how they are categorized in the insurance industry. We typically group natural catastrophe or climate risks perils into 2 categories: primary perils or secondary perils. Primary perils are the ones that we know, the large-scale, high-impact events that are well-known and widely modeled. I mean, if you take earthquake, for example, we've had earthquakes for as long as we know. And the insurance industry has successfully adapted, developed models that can help in pricing these. They tend to cause significant losses in a single event and often focus on traditional catastrophe models. Secondary perils, on the other hand, are far smaller. For example, things like floods, things like tsunamis that follow hurricanes, things like droughts and so forth. What makes secondary perils particularly challenging is that they are often underestimated and underinsured and less well modeled. Yet they are responsible for a growing share of insured losses globally. So it is important that we understand the difference between these 2 categories if we are to develop mitigation strategies, if we are going to adapt, and if insurers and policymakers are better able to allocate resources to improve risk models and design more responsive products. So while primary perils like earthquake, cyclone, and are challenging to model, secondary perils present an entirely different level of complexity. And here's why. So if you look at secondary perils, if you look at flood can happen anywhere. Tornado can happen anywhere. Unlike primary perils, which are often geographically concentrated in because of geography or the land or where you happen to be, secondary perils like hailstorms can happen anywhere. Flash floods, wildfires can occur in a wide range of areas, including areas that are not traditionally seen as high risks. So this makes it difficult to define clear risk zones. They are also highly localized. Sometimes just a few city blocks or a single valley can be affected by a tornado or hailstorm, which means that traditional large-scale models that are often used in the insurance industry may miss the nuances of local terrain and land use or microclimate that affect them. And the next point is very important, that they are influenced by human behavior. So human actions like land clearing, urban sprawl, and we saw in earlier slides how we settle in some areas, economically developed areas. These behaviors sometimes are hard to predict and even harder to model, therefore leading to the difficulty in modeling secondary perils. They also require high resolution data and advanced computing. And to model this, insurers need high resolution spatial data. And I'm sure you've seen insurers insisting on geolocation data for all the locations that you provide for them. And so in short, secondary perils are not just more frequent, they are also 1, less predictable, 2, more localized, and 3, very sensitive. I think this is the most important part. Very sensitive to human and environmental variables, which makes them very difficult to model. This makes them one of the most pressing challenges for modern catastrophe modeling that we have to grapple with. So, what does it mean for the insurance industry? This slide explores the likely impacts that you would find in the different lines of businesses. If you start with property that we have spoken about now, so heat-related impact of infrastructure assets to damage could lead to business interruption. Wildfires where they are triggered and did not really, I mean, if you look at Neisner, the potential for property damage there is significant and was significant as per the last fires that we had. If you look at life and health, of course, as heat rises, temperatures increase, they have an effect on morbidity and mortality, leading to high medical claims. So the impacts are wide range. All aspects of the insurance industry will be affected, definitely. But that's not all doom and gloom, because we see that with emerging risks, there are always two sides, as in a coin. So you can get threats, you can get opportunities. So as we wrap up or get to the end, it is important to remember that emerging risks are not just about threats. No, they also open doors for new opportunities. We are seeing increased loss frequency. Those are the challenges that we see. We are seeing greater loss severity. Those are the threats that we see. And we see new exposures. So risks we haven't seen before, cyber, for example, are becoming more and more prevalent. These are serious concerns on the left. These are really serious concerns that require new tools and new thinking. But with these challenges, there also come opportunities. If you look on the right of the slide there, the chances of developing new insurance products, cyber liability, for example, that's something that we did not know about 20 years ago, but it's one of the most widespread covers that have come up because it presented an emerging risk and a new opportunity came about. So the chance to develop new insurance products that meet evolving needs is always there. For example, parametric coverage, we spoke about it, although not yet approved in the market, but it has, on a worldwide basis, helped with climate risks to find solutions. The rise of new business formations is also an opportunity. Startups may come up, innovation, young people in the audience may start thinking about innovative ideas they may come up with to tackle these emerging risks. And that's also an opportunity that comes from emerging risks. And of course, the growing role of insurers and the insurance industry at large in risk management and prevention is also very important. So not just risk transfer, but managing risk. So in other words, emerging risks are often a call to action. So not just to worry about the threats, but also to reimagine what is possible, is on the right. I'll pass over again to James to talk about paving the way forward, what we can think about.
The way forward. As we've seen, the landscape of climate risk is evolving rapidly, and with it, the limitations of traditional insurance models are becoming more apparent. We can no longer rely solely on historical data, conventional underwriting, or reactive approaches. The risks we face today and those on the horizon demand a fundamental mindset shift. This means looking beyond traditional insurance. It means embracing innovation, collaboration, and resilience building as core strategies. We need to think in terms of risk prevention, not just risk transfer. That includes investing in early warning systems, climate-resilient infrastructure, and community-based risk reduction. It also means exploring new insurance models, like parametric insurance, as Norman has mentioned earlier, private-public partnerships, and climate risk pools that can respond faster and more flexibly to emerging risks. Ultimately, paving the way forward is not just about adapting to change, it's about leading it. And it starts with a shift in how we think about risk, responsibility, and resilience. What can the insurance industry do to enhance resilience? If we look at the graph in front of you, understand risk and exposure. We need to create an awareness of emerging risks. Furthermore, we need to develop hazard maps, more effective hazard maps, enhance NatCat modeling, and develop future scenario modeling. Pre-event resilient measures. We need to raise awareness on the resilient measures with our clients and partners. We need to assess resilient measures and assist where we can. Alert and contingency planning. It's a difficult one. Early warning systems in conjunction with weather services are preferable and sought after, in conjunction with alternative risk transfer mechanisms and parametric solutions pave the way forward. Rapid damage assessment, once that loss has happened, use of satellite data and IT solutions for efficient loss adjustment becomes key. Post-event adaptation measures, there are many, but really this refers to the evaluation of the bond market. Investigate the feasibility of developing a local cat bond to ease the increasing NatCat burden. In essence, we need to understand our risk to close the protection gap. In order to find insurance solutions, we believe a crucial step in achieving this goal is to enhance understanding and awareness of the risk and dangers from natural catastrophes. The protection gap in South Africa for the period 2010 to 2014, a 10-year period, equated to 71%, with total economic losses in the region of $8 billion and insured loss value of only a mere $2 billion or 109 billion rand. Through risk modeling tools and data insights, we were able to quantify the risk from natural catastrophes for specific areas. and ideally working with our clients and partners, unlock traditional and innovative risk transfer solutions to identify protection gaps and increase resilience in this market. That is our presentation for today. We are happy to take any questions that you might have at this point in time.
So James, thank you very much. Most interesting. I have a few questions, and this is unscripted and unprompted, but just taking pointers from your presentation and the discussion. So, and Corinne, happy that you come in here as well, because you can bring a marketing bent to some of the answers, perhaps. So, I think a large number of the audience today will be looking at and placing and advising on not the mega risks, but the rather more ordinary risks that one comes across every day. And the discussion may have seemed, well, this is really aimed at infrastructure and the bigger type risks. What would you say would be the way the average broker placing an average commercial risk should go about balancing their role of advice to the client in a very competitive market versus the sustainability and availability of insurance and reinsurance? And you know, bear in mind, we talk about average type risks, medium to large size commercial risks, where some of the discussion we've had today of closing gaps, parametric protection solutions may seem rather daunting or a little bit far out of the way. What do you say to your brokers who approach you with that type of risk?
Thanks, Barry. I think that, first of all, if I reverse the question and talk about the parametric piece for now, this is still in the very early stages in South Africa, and of course this lies with the regulator around licensing, so it's not necessarily available. I think all risks, small, medium, or large, can benefit from good advice around risk assessment, around understanding the risks that they're exposed to, in conjunction with your risk engineers, your insurers, and your brokers. Identifying these risks allows these risks to be underwritten more prudently. So whether the premium is 100 Rand or 10 million Rand, I think that with the correct data and correct analysis, the appropriate premium can be charged. So it's not so much about the size of the risk, it's about us understanding the risk. We have risks, unfortunately, in South Africa that are built, very many of them that are built within the 100-year floodplain, licensed by municipalities, but still built and still exposed and vulnerable. And there are measures that can be adopted. It could be as simple as having access to 200 sandbags to fill when the rising waters are nearing, or building a wall, a flood wall, both a dual wall, a security wall, or a flood wall to protect those premises. So there are various manners in which we go. I don't think we should, as an industry, sit back and say, well, this risk is too small. We're not going to pay substantial premium, and therefore doesn't warrant the attention. I think all risks, small and large, need the attention so we can move forward with a solid base in the industry.
If I may
Thanks,
add,
James.
Barry,
Yeah.
There's a concept that was coined in Swiss Re, which is called the degree of concern with relation to net cat or emerging risks. And what this shows is for smaller, medium to smaller insureds, the degree of concern is higher. Yes, corporates, industries do face the same climatic risks, but the degree of concern is higher. If you think about it, the relative impact on a small household, on a house, on a property on the coast, and the relative impact financially to the insureds is much more. So the degree of concern is much more. So like James says, there shouldn't be complacency. This affects everybody. This affects the entire broad spectrum of insurance. And we argue that the degree of concern is higher for households. Therefore, brokers need to start thinking in that direction. If I have properties, if I have insureds on the east coast of South Africa, what mitigation am I thinking? What trends am I looking at? What trends am I seeing in terms of developments of coastal flood and developments of hurricanes on the East Coast? And what kind of advice am I giving to my client, to my insured? Are they going to be able to build walls around them? What effective risk management solutions am I coming up with? So it affects everybody. And we argue even more so for the smaller insureds than the bigger ones.
Yeah, thanks, James and Norman. Yeah, I think it goes down to what you have said earlier on is, I think you started off with saying, be prepared. So why should, and I think you maybe answered it, but I think the question will be, well, I just own a small engineering risk. Why should I have a risk plan? You want to talk a little bit about the concept and the principle of a risk plan in terms of risk protection and where insurance would fit in one of the pillars of the process.
Barry, let me take that first, and then Norm perhaps answer it. Just to reply that question to you, say I'm a small company. Why should I adopt a risk management strategy? And this, of course, is a very, very, very valid question. But of course, one of the major concerns for an insured really has to be that if that loss does materialize, market share largely is quite difficult to regain. So overall, there is always risk, and some of that risk might not be passed on to insurers fully. So I think to be prepared, and of course, as I've tried to highlight before, a risk management plan doesn't have to be top draw, big, expensive, engineered program. Insurers, big and small, can work with the insurers and their broker partners and the relative risk management departments that sit alongside these entities and devise plans that are economically sound for all levels of insured. I think many of the smaller risks pass the risk on, as we do in households. We pass our risk on literally 100% to the insurers, save for the self-retention that might come about. Some of those smaller insurers might take larger self-retention pieces to ease the premium burden, but we'd ask them to ease the risk burden as well. I think not everything is going to be indemnified insured in terms of an insurance policy. You're not necessarily going to get back to the level that you once aspired to pre-loss. Norman, I don't know if you have any more to add on that.
Yes, thanks, James. Barry, it's all about preparedness. We spoke about preparedness and foresight. Each and every one of us sitting here today have a risk management plan. It might not be in paper, it might not be on paper, but we all do. We take out life policies, we take out insurance and so forth. It's risk management. Risk management, insurance forms but part of a broader risk management framework. And if we are to minimize the stresses that come with life, a risk management plan is required. So no matter how big you are, no matter how small you are, I, as an underwriter, one of the things I look at when I get a submission is to look at the BCP plan to see if the insured is prepared in the event something happens. And we do not ask how big they are, how small they are, because we realize that resilience is built from understanding this risk management framework, which also includes insurance. So risk management is key.
Yeah, thanks, James and Norman. And I would agree with that. And I think it comes back to the basics of broking and giving advice. And that is one of you need to understand, first of all, your client's business. If you don't understand your client's business, you're at risk in not advising on the correct solutions. And those solutions may not necessarily, in this day and age, be one of insurance, but it could be the balancing of risk mitigation, risk management, and using insurance as one of the pillars. We've heard quite a lot about, and we do hear, and in particular we hear that coming through from the Treasury and the PA and FSCA, they talk about this thing called parametric. And I think maybe what we could do is just spend a minute or two just to position where parametric is at the moment in this market, but maybe the step before that, in very simple terms, in a sentence or two, Norman or James, to say what is parametric protection, and then where it sits within the local regulatory format. I think if you could just spend a little time on that. In my view, I think the regulatory environment is overplaying parametric. I think they are creating the thought process that parametric could be the savior of all things, which I don't believe it is. I think it's very risk or protection specific. And maybe you could, from your point of view and your expertise, just talk about that.
Yeah, thanks, Barry. So where is parametric in the SA market? A very, very good question. As I alluded to earlier, it still sits with the regulator. As a regulator grapples to license it as an insurance product. So that's kind of where it sits in the space at this point in time. And quite correct. I think you've hit the nail on the head. Parametric is very specific and could be a fairly costly tool. But in essence, what it would drive would be a set of parameters. If achieved, a certain payout can be achieved. For example, drought or humidity. So a level of humidity in a soil, if your soil gets to a certain temperature, then you trigger the policy or you trigger the relief as such. So we're a little way off in this country in securing those solutions. And those solutions aren't open to everybody, perhaps. There might be an affordability thing. And of course, the events you cover might not necessarily be available because there's you can take anything from levels of precipitation to humidity in soil to hailstones in various sizes, whatever they might be, if you have crop insurance. So it's very variable in nature, as they said, to strive out on these things. Norman, I'm not sure if you have anything to add on that.
No, Jeff, that's fine. Thank you.
So I'm not sure, Barry, if that answers the question. I'm sure you can detect I'm probably equally as confused as the rest of us around this piece, and whether it is going to be the Alexa. I don't necessarily think so. I think it's going to be a pricey alternative. Let's just put it that way.
I think just to add to that, to say, from as far as I'm aware, the regulators have a. Just first of all, I think the issue is, and one of the reasons behind not allowing parametric in terms of the Insurance Act is that the regulators are saying that it does not give indemnity protection, which the Insurance Act requires. So that is the one issue. I think very simply what it says is, and with the application of parametric, I could have a claim and Norman could be my neighbor. He doesn't have, I could have a loss. Norman is my neighbor, does have a loss, and we could both be paid out based on the principle around parametric. And I think that's one of the concerns the regulator has. However, they have agreed on a sandbox project to allow it for certain agri-products. And as far as I'm aware at the moment, it's Santam and the Land Bank who have applied approval of their products. So I think it's one of those things to watch the space, but I think it may be, and knowing the speed at which our regulators and Treasury work in agreeing things, this could take a while before it actually is introduced. What I would say to the audience, do some research on parametric. Go to your markets, and just as a tip, if you can add in a damage proviso to your policy wording, you may be able to get closer to getting a market which will allow you the principle of what it is all about. But if there are any questions on parametric, happy for people just to email me, and then we can try and address those specifically. And then, but just a little bit of time left. Just very quickly, I know it's not your domain, but we hear so much about the reinsurance market. But it's the reinsurers doing this, that, and the next thing. Where are we with the global reinsurance market in terms of availability of capacity, and also their view to risk acceptance? So what I'm saying is, well, here's that the global capacity is increasing. Reinsurers are relaxing to a point, but at the expense of risk management. Any comment on that?
Yeah, I think I'll kick off, and of course, Norman, a good thing, has a reinsurance background, so we can lean into that a little bit. But I think if we just look at let's just focus on the Nat Cat piece, because that seems to be the central theme of today. Global capacity for Nat Cat insurance and reinsurance markets, largely driven by the reinsurance markets, of course, sits at about $550 billion worth of capacity. And then, of course, in the US specifically, there's a further $50 billion cat bond coverage that's available. So about $600 billion. And hence the concern, if we look at the insured versus uninsured gap, as that creeps towards those capacity limits, what will the outcome be? Where will it go? And of course, we also understand that in areas where the events have become numerous, or it becomes a case of not when, but how big, insurers tend to shrink capacity. And in some cases, if we look at the UK, there are issues where markets are, insurers will be leaving certain countries and counties because of the flood position. So, yes, and I'll hand over to Norman about the insurance piece, but reinsurance is key to an insurance company, and have reinsurance treaties of various sorts and various structures, and they can drive behavior to a large degree. Norm, anything
yes,
to add?
if I may just add this piece. So from a modeling and pricing point of view, I'll speak about that, James. Speaking to my colleagues on the reinsurance side, they say, you know, the models for what we spoke about, the primary perils, so the earthquakes, tropical cyclones, and so forth, those are pretty robust. And the reserving on all of those is quite robust. What the reinsurers put aside is quite robust. But the key are the secondary perils we spoke about. Those small, isolated, localized cat perils. Those are the ones that are causing problems. And if not successfully or well managed, may lead to capital strain because they're ever on the increasing trend. The climate change. So from a modeling point of view, we're not in a dire situation yet. But if we continue on this trajectory and there is no change, one, to the modeling, two, to the reserving, putting money aside for eventual claims, we may face problems. But I'd lean back to the numbers that James gave in terms of the capacity that's available currently for NatCat.
Thanks very much. Sandra, if you want to pick up any other questions.
Thank you very much. And I think the question about the parametric insurance was raised in the Q&A. So thank you for covering that. I think it was seen as it's going to come as this big resolution for problems that are happening, but I certainly think you've covered that nicely, put it into perspective of where it needs to be seen. Barry, I wanted to put actually my colleague Bernard here is on the spot, and as we were talking about, you know, risk management plans and emerging risks, you touched on cyber and that. I think, you know, it's responsibility of all parties for us to be thinking about those risk management plans, and then an organization like the FIA as well. I mean, we look to our own brokers to say, what are you doing in your businesses? How are you putting risk mitigation to your own businesses? And I know, I'm hoping that our members are aware of the Member Shield product that we put together for our members, for them to consider, you know, their own cybersecurity risks in their businesses as well. So we've got maybe 2 minutes there quickly. Bernard, if you want to maybe just remind our members to reach out, because they also have a responsibility to almost set the example within their own businesses as well.
Yeah, thanks, Sandra, and thanks, team. Amazing webinar as usual, and thanks for a quick opportunity to chat with you. As you rightly say, Sandra, we actually have been talking a lot about risk, and funnily enough, the same thing came up to me. Cyber risk, you know, that was discussed as well, is something that is increasing and has been increasing for some time. So with that being said, we as the FIA actually developed a bespoke offering for FIA members that looks at enterprise-grade cybersecurity. So it's IT cybersecurity for FSPs that we have developed in partnership with First Consulting Alliance. So we do have 3 flexible packages for our FSPs, for our members to use, and there are different offerings in that package available. We have made enterprise-grade security available at a very, very low cost, specifically to our members. So please do reach out. You would have also seen, you know, the joint standard cybersecurity recently came into effect. There are many things happening in the cybersecurity space. So please feel free to reach out to us. It's membershield@fia.org.za. And something that Norman said, you know, stuck with me, and I actually wrote it down. He said, foresight is about preparedness, not prediction. And Member Shield speaks exactly to that, to the preparedness, because we are all at risk at some point in time, but at least being prepared with having the right things in place for your cyber and your IT security takes you that next step further. So yeah, membershield@fia.org.za. Please feel free to reach out to me. My email is bernard@fia.org.za, but I will also drop it in the chat if anyone wants to engage with me further on it. I'm also happy to take questions or comments from the team, but yeah, thank you for giving me a few minutes to chat with our members.
So Bernard, do you think that advert's coming for free?
Anyway, imagine so, Mr. Chair, but I'll happily pay the tax on that one. Yeah, thank you for having me, the audience.
So what I will say, Sandra, before we close, and just to support James and Norman and Corinne have put together for us today, is that the FIA have developed a series of risk management recordings or webinars. It's going to be question and answers on the whole process of the risk management process and the different pillars. That it was 8 and we put it down to 4 pillars that encompass the issue of risk management. So we involved the likes of Chris Palm, who was IRMSA, Michael Duncan, and a few other risk experts from the industry. So very shortly we'll be making 4 modules available to all of our members, which will take them through from step A to Z in terms of the risk management process, why plans, etc., etc. And we will have the experts talking on this. So perhaps we leave it at that at this point in time. Suffice to say to James, Norman, and Corinne, you've been very quiet today, unusually quiet, sitting in the background. Thank you so much for all the time that you have devoted. This has taken a long time to get live, but it's very much appreciated. So thank you from our side. Sandra, over
Pleasure
to
is
you.
all ours. Thank you very much. Thank you.
Barry, thank you. Sandra, thank you. Bernard, thank you. And of course, all the members. If you have any questions, Norman and I are happy to answer those by email or telephone if you require. So with that, thank you very much. Barry, I think I've got a title for your next one. I'm not the expert, but maybe it'll be Parametric, Pandora's Box, or Alexa. I don't know, something like that,
Nice.
perhaps. And yeah, Member Cyber Shield, cool, very cool.
Yeah.
Thanks for the time, thanks for the opportunity. We really do appreciate it.
Absolutely. And may I
Thank
close
you.
with this, Barry? Debbie has posted something on the chat.
Yes.
Where she says, brokers, we are increasingly finding ourselves bearing the burden when things go wrong. And one thing that we've noticed for us on the insurance side, if I may close with this, is that just being a capacity provider, the days of just being a capacity provider are gone.
Yeah.
We need to come up with value adds for the client. We need to show something meaningful that separates us from, dare I say it, Allianz, Santam, and everybody else. And I think this is how we need to approach this as brokers. Look at innovative solutions, ideas, fresh thinking that will be instilled and beneficial for our clients. Perhaps we won't be blamed that much, Debbie.
So Norman, would you like to become a broker?
Very incidentally, I tried it and I respect brokers. No, thank you.
Well put.
Okay.
Thanks, everybody.
Thank you, everybody. Bye-bye.
Thank you,
Appreciate the
everybody.
time.
And